Along with management competence, it is very important to have management interest directly aligned with common shareholders for the long-term success of a company and stock appreciation. In this session, I will cover some of the traits of owner-oriented management. In previous session, I explained management analysis framework. We classify management analysis into two broader categories: qualitative analysis and quantitative analysis. Qualitative analysis is subdivided into three sections. We assess management quality through well-defined checklist to understand positive and negative traits that helps with investment decisions. We also ensure management is owner-oriented, having right motivation to take decisions that have positive impact in long term. Lastly, capital allocation decisions to drive long-term growth and appreciation in stock value. In this session, let's understand the traits of owner-oriented management. What does exactly owner-oriented management mean, and how do we know management fulfills the criteria? An owner-oriented management is one who has personal interest directly aligned to the shareholders of business. In India, there are many businesses that are owner-oriented. Here are few examples. These businesses have created immense wealth for shareholders over the long period of time. When management has majority of their personal wealth invested in the company, their decisions will be long-term oriented, benefiting stock in future. On the other side, if management has heavy stock options as compensation, they will be enticed to take decisions that will benefit stock in the short run so that they can exercise their options. In order to understand the owner-oriented approach, you should look out for shareholding pattern and check how promoters' ownership is changing across years. If management holding is increasing or stays constant, it shows their confidence on future prospect of the business. On the other side, when management holding is decreasing every year, it's a red flag and one should investigate in detail. You can review Yes Bank promoters' holdings over the years. You will notice promoters' stake was declining over the years and finally stock collapsed by more than 95%. However, during the same period public stake almost doubled. You better understand who paid the price. If something is wrong with the business, promoters are the people who knows first. Hence, their action should be monitored closely. In addition to the promoter's holding, you should look out for pledging of shares. In simple words, pledging of shares means taking loan against the shares. Bank will disburse loan to the company, and shares are pledged as collateral assets. Pledging of shares can be used to meet different needs like working capital requirements, funding growth, carrying out new acquisitions, and so on. Pledging of shares is risky for the shareholders. Stock prices keep fluctuating every day and hence the value of collateral. In most cases, the promoters are required to maintain the agreed or minimum value of collateral. If the price of share falls, the value of the collateral will also erode. In order to meet the difference in collateral value, the promoters might have to cover the shortfall by either giving additional cash or pledging more shares to the lender. In worst case, if promoters fail to make up for the difference, the lender can sell the pledged shares in open market to recover their money. You should continue to monitor promoters' action and ensure shares are not pledged. Owner-oriented approach is one of the important considerations for long-term success. One should closely monitor promoters' action and potential red flags early in the process to safeguard against catastrophic losses. Thank you.